Today we are covering fiduciary duty and prohibited practices for the Series 65 exam. This is a heavily tested area, focusing on the legal and ethical standards investment advisors must uphold. The exam will test your understanding of the core components of fiduciary duty, loyalty, care, and good faith, as well as specific prohibited actions like front-running, churning, and commingling. You'll need to know not just the definitions, but how these concepts are applied in real-world scenarios. The fiduciary duty is a foundational concept in investment advisory services, legally obligating advisors to act in their clients' best interest at all times. This duty is composed of two primary pillars, the duty of care and the duty of loyalty. The duty of care requires an advisor to provide advice that is suitable and in the client's best interest. This involves making a reasonable inquiry into the client's financial situation, investment objectives, and risk tolerance. For example, recommending a high-risk speculative investment to a retiree with a low-risk tolerance would be a clear violation of the duty of care. The exam might present a scenario where an investment is technically suitable, but not in the client's best interest due to high fees or a conflict of interest. Another key component of the duty of care is the obligation to seek best execution for client transactions. This doesn't just mean the lowest commission cost. It involves considering the overall value, including the speed and quality of execution. The duty of loyalty requires an advisor to put the client's interests ahead of their own. This means an advisor must avoid, or, at a minimum, fully and fairly disclose all material conflicts of interest. A common exam question might involve an advisor recommending a proprietary mutual fund that pays them a higher fee than a comparable, lower-cost fund from another company. Even if the proprietary fund is suitable, the failure to disclose the conflict of interest and the potential for a more cost-effective alternative would be a breach of the duty of loyalty. The disclosure must be specific enough for the client to make an informed decision. Now let's turn to specific prohibited practices. Front-running is a classic exam topic. This occurs when a professional trades on their own account based on advanced knowledge of a large client order that is likely to move the market. For instance, if an advisor knows a large institutional client is about to place a massive buy order for a stock, and the advisor buys that same stock for their personal account beforehand to profit from the anticipated price increase. That is front-running. Churning, or excessive trading, is another prohibited practice you'll see on the exam. This involves a broker or advisor trading excessively in a client's account primarily to generate commissions, not to benefit the client. The exam will likely test your ability to identify the key elements of churning: control over the account, excessive trading frequency, and intent to generate commissions. A high turnover ratio, for example, could be a red flag for churning. Commingling is the mixing of client funds with the advisor's personal or business funds. This is strictly prohibited. Client funds must be kept in separate trust accounts. An exam question might describe a scenario where an advisor deposits a client's check into their firm's operating account. This would be a clear violation of the anti-commingling rules. Disclosure obligations are a critical part of an advisor's fiduciary duty. Advisors must disclose all material facts, including any conflicts of interest, in a full and fair manner. This is often done through Form ADV Part 2, also known as the brochure. The exam will test your understanding of what constitutes a material fact that must be disclosed. For example, if an advisor receives referral fees from other professionals, this must be disclosed to clients. Finally, let's touch on best execution again. The duty to seek best execution means an advisor must strive to obtain the most favorable terms for a client's transaction under the circumstances. As mentioned, this is not just about the lowest commission. Other factors include the size of the trade, the speed of execution, and the financial responsibility of the broker-dealer. To help you remember the core components of fiduciary duty, think of the acronym LCG, which stands for loyalty, care, and good faith. An advisor must always act with loyalty to the client, exercise due care in their recommendations, and operate in good faith. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.